fundraising was so hard, right? I think this tea story is hilarious because I think it like totally encapsulates just like, honestly, the shit we also had to go through, right?
This is when we're raising the $49 million fund too, our first institutional fund. So it's early days. Still figuring out who to talk to, and we went to this LP conference. Basically, this event is one of the few that actually brought together GPs and LPs. And what's really, looking back, what's crazy is there was 2 distinct sessions. One was the GP room hearing from farther along managers and maybe one LP that goes and talks. But the other room was really the LP event and like hearing a couple pitches. And the only way to get access to that other room was in the middle, which is this big open, banquet hall where there was just tea. And what I did that day, as we're desperate for pipeline, I'll never forget, I flew to SF. There was an attendee list. I looked up in the days before and on the plane, every attendee, every LP I could possible, learn their names, face, had done some recon around like who could be a fit for us, who's not too big, because at that point we're learning a bit. And I had my hit list. And what I did is I stood by that tea table and anytime an LP went to get a coffee or tea, I got a tea. And I would stand next to them.
Speaking of lurking.
The lurk was real, and it was shameless, and I felt like garbage doing it. It was so humiliating, but I stood by there,
you would, like,
made
sidle up to them.
Nice mint tea, sidled up, and I'm, hey, how are you? I'm John, what's your name? Obviously, I knew who they were at that point. And then I did the little elevator pitch, but it was the tea pitch. And in the time that they were putting their sugar or their milk in their tea or coffee, I had a pitch, and a lot of people we weren't a fit for. But I got a few follow-ups that day. And the funny part is, I did that for hours. So literally I would make a tea, and I can't even drink hot stuff. I'm iced coffee every day. So I would have some of it and then put it down somewhere. And then I'm waiting like 6 minutes. I'll have that tea finished. Someone else comes and I run and do it again. And like every 3 teas now, I'm like, oh shoot, I have to go to the bathroom. So I'm running to the bathroom and then I'm waiting for more people. But that is the famous tea story because we just grinded it out. Yeah. We were shameless. And if you're not willing to do that and put yourself out there, then you shouldn't be raising a fund.
So thrilled to have you with us today, John, on the drafting table. So I'm pretty sure in the last 12 years, you and I we've definitely never been on the same pod. I don't think we've ever been on the same panel or meetup.
I don't think so. That's crazy.
Because it's always been divide and conquer, JL squared, Jesslyn, John Lehr, but like we've never had a conversation like the two of us. So that's why this is really special. This is a long time coming, literally 12 years coming. And by the time this pod comes out, we will have announced our Workbench Fund 4.
Big news, big exciting news.
So that's really, we'll talk a lot more, but it's just like so special to be able to talk about that here with you. And as you know, this pod usually talks about what founders should know before they start a company. And so we thought we'd take a twist on it for today and have it be about what we think emerging managers should know before starting a new fund. And basically all the shit we did not know 12 years ago, which was so much.
That almost thankfully we didn't. So we could just go in blind and then tackle each challenge one at a time.
I totally agree with you, right? Like I say it all the time, like if I had known all that we would go through in this last decade, like I would never have joined, right? Like,
it was a wild ride. It's been a wild ride. Yeah.
It's still a wild ride.
Every day is.
Every day's a new ride, but obviously we both feel super lucky. I know I speak for both of us that like truly the best job on earth. Yeah. And obviously so lucky to do it with our incredible team here in New York City. So what about we go into the origin story, maybe about Workbench first, and maybe if you want to do the high level overview, and then we should talk about how we met. I feel like people like always like think about that. And then we do have 12 emerging manager lessons learned 12 years into Workbench. So we'll do
We're going to dig into all of that.
Yeah. All right. So do you want to do the honors on Workbench?
The Workbench spiel. So as we're about to unveil Fund 4, let's take a look back. So at Workbench, seed fund dedicated to all things enterprise software and all things enterprise go-to-market with our New York hustle. We made an early bet over a decade ago that New York would have a thriving enterprise community. Brick by brick in our old office and through all the meetups, we wanted to build it ourselves. And I think looking back, it's in a very good place now. And the bet was that startups would want to build close to their customer base, especially all the Fortune 500s we have here. And then for me and you, coming from IT world, which was really unprecedented, and frankly, most people would think that's absurd back in the day. And that's something I'm really proud of how we've just changed the game. And really that vision that we had in 2013 to just flip that model entirely, right? Instead of starting with the tech, like most Silicon Valley enterprise funds do, to be here in New York, tap into the corporate IT community and actually start with the pain point. Where are budget dollars going 12 to 18 months out? What are priorities? What are the pain points? And what's going to get that focus so that we can invest where the puck is going and take those insights to develop investment themes. Be very public about it, right? Blog about it, publish about them, host the meetups that we do, all the events from the 250-person events, 10-person dinners, everything in between to attract the best startups, and then to play matchmaker where at the end of the day, you and I always say customers are like oxygen. So that startup is getting that breath of air to that curated intro to the right person at the right time in the early days. And importantly, the customer is getting that curated introduction themselves to solve a pain point that they have. And for us, we're doing right by both sides and then being able to invest in the best.
Yeah. And the really cool part, as I reflect, is like we've really done that every day for the last 12 years, right? Like the model, the strategy has largely stayed the same. The fund size has changed, we can talk about, but like I think something you and I are both proud of is like we've just remained really disciplined and really consistent, which has been really important because over 12 years, we've seen a lot go down in 12 years, right? And we're going through, cycles even now. And I think that is one of the biggest learnings we can talk about is just like how do you stay really consistent and how do you stay disciplined?
That discipline is one of the things that I think when we went out to raise this fund, LPs commented on the most. Well, actually two things. One was discipline. The other was our passion that over 10 years in, we're waking up so excited every day, which we both are. But doing this in New York, I think also helped us because imagine if we were in SF getting a coffee somewhere and you hear at a Blue Bottle, FOMO this, FOMO that. Like, we know what our model is. We know what we do every single day. And to be laser focused on continuing to develop those investment themes, to be looking out, to meeting the best startups. And really, we always call it that circle of life to go from thesis to company to then making those intros, supporting the go-to-market, and then just continuing on. That lets us really help them scale and inflect at those early stages so that they can raise Series A, B, and beyond. And probably the hardest part has been not in terms of the fund size and the strategy, but actually sticking to it, where a lot of people fail. Like think about Fund 3 we turned on early 21, peak ZERP. Some of our first few deals, when we're looking out in the market, we're offering a term sheet, a few $1 million round, high teens, let's say, and then a big firm is saying, hey, take a blank check or take 7 on 30 on 40 post. And when that's happening over and over again, it could be easy to say, hey, do I have to break model? Do we have to do something different? But something I'm grateful that both of us did is actually just work harder to find those entrepreneurs that are long-term oriented, align obviously dilution and ownership needs of the investor together, think long-term. And, some of our companies from 21 have really broken out that we've invested in from that period.
Yeah, I think it's just a reminder, and we say this to our team all the time, great companies, but not necessarily great deals for us, right? And the thing I think we didn't know in the early days, we believed it, like we had to believe it, but like we didn't really have proof in the pudding was that if we stuck to our guns, would, the returns follow? And obviously had a lot of faith that I would have to. And I think what's really cool is 12 years in, we're seeing a lot of the seeds that we planted 12 years ago, obviously on performance, really coming to bear now with a lot of our later stage companies. But the other thing I just feel so proud of is really the community piece, right? And that was, again, it sounds so obvious now. Like, of course you built a community in New York City, but like in 2013, 2014, New York City was not a startup scene, nowhere like it is today. And if it was very much a consumer town, right? And we were the only ones, like literal enterprise nerds, like going around beating the drum and trying to get people interested in enterprise and B2B and SaaS. And that's also, that tide has completely changed. I mean, I think most founders actually really love the B2B SaaS model, the repeatability and so forth. So I think that's a part. I mean, a lot of the early days we'll talk through was just building structurally into the fund model, the community piece. And when we say community, like I really genuinely feel that we are unique in that it's like really core to our DNA. Like we don't just throw events because we're like, it's going to be deals and deals, right? It's because we genuinely believe like if you bring smart people together across the suits and the hoodies, that great things will happen. And that's the cool part. Literally 12 years in, we've seen over and over again we're backing founders now that we've known 5, 6, 7 years, right? those were not things we knew from day one or even day 100 or even day 200. And to your point about New York, I think it's being an underdog. I hope we never lose that underdog mentality, right? And like constantly waking up every day and wanting to prove ourselves, right? And I think it's affected the type of people we've brought on board. It's also, I think, affected the types of founders that we attract in a good way. Like we want that, right? And I always say like, even just doing our one thing really well and like staying in our swim lane, but doing this part of the swim lane really, really well, $160 million fund 4 to keep doing what we love best, which is enterprise, seed, and supporting the hell out of go-to-market. I mean, it's still a dream.
Completely. And I think when you think back to the early days, and again, this community bearing fruit, it takes work, it takes investment, and it is being long-term oriented enough to say, again, I'm not transactional. I'm not doing this one dinner, and if it doesn't turn to a deal tomorrow, I'm not going to do another one.
Totally.
We've seen things that have converted a year later, 18 months later, multi-years later. Like think about in the old office meetup days, like we've had now some of these founders in Fund 3 and soon in Fund 4 that we've known for years.
Totally.
And that's the cool part, because now we have that relationship. They've seen who we are authentically, and we can move faster than any other firms and be able to have that edge to win the deal.
Yeah. It's like, I really do feel, I mean, I'd be curious what you think, like, you know, when people are like, what are the early days? Like, I honestly, I like can't even remember, because I thought it was so hard, right? Like now when we say Workbench, I feel pretty lucky that like if you've been in New York City long enough, you've at least heard of our firm, you at least know generally what we focus on. But like in the early days, people were literally like, what is a Workbench? People thought we were Benchmark, right? And so the early days were just like pure, just like heads down and grind, I would say. And then there's like the valley of like, you know, I feel like the VC valley, which is like, you think you know what you're doing and then you realize you don't know what you're doing and there's like a little dip. And then you come back up. And I think when you come back up, that to me has been the fun part, right? Which is like, you get enough reps in, you get enough wins, even if they're micro wins, because again, this like venture journey is so long, that you actually think, okay, this is fun, like intellectually fun. And that's a part that I think, unfortunately, a lot of people just are not in venture long enough to see that. Like that took for me like 7 years, I think. Maybe for you it was earlier because you've loved the shit out of this stuff. But, you know, I think there's a difference between like this is really, really hard versus like, oh, I see enough patterns that it's like intellectually like a different mind game.
For me, the hardest part in the early days, it's kind of what you put out, which is doing enterprise, doing it in New York City when no one really, it just wasn't a thing here. You had customers here, you had the big enterprise software companies that would have sales reps here, but there was no VC here really doing enterprise at the end of the day. You think about the ecosystem at large, Datadog was just getting going, MongoDB was still early days. So there wasn't the proof points yet. And I think about even us, every year we used to put out the funding report. Every week in Enterprise Week, we curate fundings. And 2014, we're like, oh boy, $577 million in funding. We're doing it. And then, it grows and it grows. And eventually when you're getting billions in annual financing to local enterprise startups, once you're seeing categories across stuff in the app layer, across infra, dev tools, security, it's like, okay, there's a mix of companies here. And then you see the talent that starts coming where, remember that knock used to be, oh, you can't get marketing leadership here. You can't get good product or engineers here. But as companies have matured, as companies have scaled, that people have moved here from, SF, other geos, we're a robust ecosystem. So no longer are we trying to like say, look at me in New York. Like it's a thing. And now it's more so, all right, where do we go from here? What are the best companies?
Totally. It reminds me a lot actually of Bob Tinker, a very good friend, who has this analogy about riding the wave, right? Especially for when you find go-to-market fit. In the early days, it's such a grind and every deal you close is so hard. But at some point, you do feel like a wave come, like a surf come. And that's when you start surfing. And that's what I mean perhaps by the fun part, right? When some of these tailwinds started coming, I think that was like, again, you got to just like spend years building the kite. But when the wind comes, like that's the cool part, to actually see the kite lift. So, and more to come, right? Like 12 years in, I still feel like we are still in the early innings, actually, of so much of Workbench. And there's still a lot more to do. And we can talk a little bit, but like the things I know we talk about every day that we think about as a fund is very different than the early days, right? Like the things we're thinking about now is like, what should we keep? What should we keep doing? New York City keeps changing, right? And so actually a lot of the strategies we had even early days, do they continue to make sense? Like, we should not assume anything is permanent. There's a whole new generation of founders now, like so many. And so we got to keep earning our stripes as well.
Yeah, I mean, that's the cool part where I give you credit. We're never complacent, and it's always questioning. So we have the hustle as a starting point, which is critical, right? So many people 10 years in may just kind of get lazy. No one on our team feels that. We're all hungry. We're all out there. But to your point, as the ecosystem evolves, where New York's a thing, but now it's maybe getting bifurcated in different ways, for those transplant engineers that move from SF that may have been at hypey Silicon Valley companies, may have their own existing relationships with VC friends. When they're here now, how do we make sure that they know about us and that we're that early call, and that if they're building an enterprise, we can be that partner to help them? Totally. Or the other side of the house, those seasoned vets, multi-time entrepreneurs, or people that maybe have a couple decades more experience under their belt and are going to build something in a category that we just know and care about deeply and have researched and have the corporate context in. How do we find both of those groups in today's world where there is more noise, more content, more podcasts, more events, and it's just continuing for us to refine? And that's part of the fun of this job with you every day now. It is saying, all right, we've got this menu. What are we going to dig in on and what are we going to cut?
Totally, totally. And the work never stops, right? Like, truly, it really never stops. And we're so lucky, honestly, to just get to work with some just truly exceptional founders, like some of the best in the world, and the best team. Okay, so we've talked a lot about the things we've learned, you and I, and then we've talked with a lot of other GPs over the years. And I will say, I think we are so lucky in the sense that neither you and I came from venture. We can talk about that a little bit, but we really did not come from venture. And so we didn't know how to raise a fund or think about fund portfolio construction, right? And fund management. We always say that's one thing. There's a difference between being a great investor, great fund manager, and great firm builder. And those are three actually very different things. And it's actually, I think it's very hard to do all three well. And I think that's something you and I are very, very driven to try to really be thoughtful on all three. But the reason I say that is because we literally didn't know anything. And I think back to actually so many GPs in the early days who were actually so kind to us, right? Like, I'll even give a shout out to Mike Brown at Bowery, who we sat in his office, he opened up his data room to us, and we were like, this is what a data room looks like. This is what we need to put together, right? And I do think now there's more than ever a ton of resources out there for GPs, which is so great. I mean, it was very limited back then on what was written about and what was shared. So we really learned the hard way. And I think one of the things that you and I both feel really passionate about is how do we share and give back, especially to emerging GPs, and so that they don't have to go through the same things that we have. And you put together this great list of 12 things.
Let's get into this list.
Okay, cool. All right. So number one, this is the first one. So if you're raising a new fund, the number one thing you have to do is you have to go and find LPs to invest in your fund. Now, LPs is a big word because there's a whole universe of LPs. Do you want to talk about at least some of the segments of LPs and how to even think about that?
Yeah. So again, thinking back a decade plus ago, you couldn't Google really who are LPs. You didn't know who did it. Thankfully, fast forward today, there's incredible resources out there, whether it's Sapphire Ventures, right? Beezer has really championed this whole open LP initiative. Yeah. Whether it's people like Samir Kaji, who was very helpful to us also in the early days, really trying to just teach the next generation about things that were unknown, right? Unless you've lived it. And for us, as I think about the evolution, right? When you're an emerging manager just getting going, most institutional LPs are not a fit for you. It's the same way as a seed startup, you should not be talking to a Series D or E investor. It's just not aligned.
And the reason for that is twofold. One is obviously just perhaps your track record, your performance, but two is just it's a function of your fund size, right? So if you're a sub $100 million fund, who you talk, and then sub 50, so sub 50 and then
even
sub 100,
sub 50, yeah.
Right, are totally different check writers for whom investing in your fund actually makes a difference in what they deploy. Right?
I remember you and I spent a month and a half in the early days trying to get lists of pension funds. In that example, right? Our fund 2 was 40 million target. We ended up hitting 49, just about the hard cap. And we spent a month and a half trying to get this list. Finally, someone gave us a PitchBook login. And then we went through in Excel out in the dump and went, all right, who's our first, second, third degrees? And then you get all these meetings done after all this work. And it's wait, their minimum check size is bigger than our entire fund. And it was just totally the wrong place to talk to. So like that's an example of it's just a total misalignment versus, when you're sub 50, it's really high net worth. And then from the institutional base, some of these family offices that could do the $500K up to several $1 million checks. And then there's a lot of fund-to-fund groups there that have dedicated emerging manager programs. And even before you start raising, making sure you start to know them, you build those relationships. And really tied to this is the pitch as well. Like we've heard this so many times, but you can't be yet another seed fund. There's too many of them out there. Yes, there's a lot of opportunities in venture, but what is your angle? What is your story? What's your differentiation? And how does that last to source, win, and scale?
Yeah. I mean, in a lot of ways, it's similar to the same pitches we talk to our founders. Like, how do you have a truly defensible moat, right? And I think at the end of the day, you need something structural in a fund, right? That truly differentiates you from others. And that's the hard part, right? And we can talk through other funds. For us in the early days, it really was a community. I think it was the fact that we hosted 200 events a year and that we just went and saw and met everyone in New York City. I will be the first to say, I think we have to continue building on that now, right? And think, okay, what is like the structural advantage we have for the next 4 funds that we raise, God willing, right? And so, I think that was a huge lesson. The other is just like, and raising for a fund is truly like enterprise sales. Like the most enterprise sales.
Yes.
Harder than enterprise sales because to your point, a lot of these buyers don't want to be found, right? And so we've really structured so much of our process to be like, okay, the first call, right? How do you move them through the funnel? What is the sales enablement needed at each stage? You were really the best SDR you could ever ask for, right? Yeah.
So again, it was putting together different tips. So if we think about like the qualification, a lot of managers are so happy to just get on the phone to pitch an LP. But you have to know, where are they at in their own cycle? Are they doing venture, right? If they're institutional grade, what percent is privates? What percent is venture of privates? Where are they at for their allocation on the year? Like these are things you just don't know if you haven't lived it and asked. But starting the meetings, and it's not transactional, but just from an informational perspective, hey, I'm going to give you my story, but help me understand yours first. Tell me about your program. What do you manage? And then things like, where does venture fit in? Are you thinking about it? Have you been doing it for a while? Do you have a whole roster of the big Silicon Valley blue chips and emerging manager is new? Have you been doing emerging manager for a while? What's your average check size? How many bullets do you have for the year, right? You'd be shocked, but you could talk to someone in February and they're like, hey, I'm actually done for the year.
Absolutely.
And you're
that
like,
happened so many times for us.
And when they have a roster of managers who come back at a certain cadence, and then some may be actually coming back earlier than they would have thought, and maybe something changes their own budget, and maybe they had that one new manager they've been tracking for 2 years who finally said, I'm raising, they're done, right? So that when you talk about the sales process, there's so many variables that could get them out that you really need to have. In enterprise sales, you want 4x pipeline coverage on a quarter.
Oh man,
you need like much bigger
10x,
here. But honestly, it might have to be something like that.
Because so much of it is timing. Obviously in enterprise sales, we talk about budget cycles, and so this is like a timing. These timings could be years, truly, right? And obviously that's why they say always be raising, right? But like quite literally, if you want to close a fund in 2026, if it's institutional, you need to have been talking to some of those institutionals for years before that.
Yes.
Right. And I'm the first one to say, like, we are so lucky now to have like incredible group of LPs who support us, but many of them are LPs who tracked us truly for 5+ years.
Oh, for sure.
7+ years. Right. And so much of it is timing, and you just can't always predict the timing. So therefore you always need to somehow be building those relationships. So that is definitely tip number 2.
And the trick is how to do it in a high leverage way. Yeah. Ultimately, we're meeting companies, we're meeting corporates, we're working with existing portcos beyond the sourcing, list goes on and on and on. Where does net new LP outreach come into play? And part of it is building it into your own systems and processes, right? We host tons of events. And by the way, the cool data point when you think back to Fund 1 and 2 days is 70% of that deal sourced was from the community, right? So it's like having those stats to back it up. And then when we're thinking about the events we ran, if we're doing a meetup anyway and it's massive, sure, invite some LPs to it. Let them sit in the back of the room and see what's going on. We've got an interesting dinner coming up and it's relevant audience to them. Maybe someone FinServe or something like that. Bring them in. Yeah. And being able to have that as a high leverage way where it's like, we're doing this already. We're not doing a bespoke event for them. So it's not off model. It's just getting more out of the work that we're already doing. And I give our team a lot of credit for that, because even when you design the quarterly letter format, like we hear from LPs all the time, hey, my GPs won't even share information with me. We take the time and we put in updates around how do our activities tie to deals sourced, won, and scaled. We give portfolio updates. It's packaged really well, and they're getting that dose of information. And then when we tie that in with another one of our tips that emerging managers should try to copy is we do a quarterly webinar. So we have existing LPs, and that is guarded where it's only the existings. But closer to fundraising cycles, we open up that a little bit to let some of the prospective LPs who have spent time with us get to know us on a deeper level and see what they would be getting if they're an LP of ours. And it just builds, again, that authentic relationship. It builds trust, and they see us in action.
I just was talking about this with another manager just yesterday because, I think it's hard to ever be able to game or really time. Like, okay, I know this LP is going to have a slot open, therefore we should meet with them. It's just too hard, right? And so how do you just build in public a little bit more? And I think that is like the philosophy behind this, and not so public. Again, we're not having this be an open public webinar, but being thoughtful about the ones who can get an inside look into what we're doing. But it's also not just, hey, come and meet us and do a one-on-one meeting, right? I call it a little bit of like the lurking effect, and we can figure out if we want to keep this in. But like, how do you let them lurk a little bit? Right? And let them kind of track you on their timeline. And so that when something opens up on their end, you're primed and ready, right? And so that means you do have to build out in public, because you need to be sharing like a decent amount of information out there that they can be building conviction. And that's the part that, I think I do give us credit. I think we thought in the early days, okay, we obviously send a newsletter out every Friday to 35,000 people, which is a ton of work. So shout out to our whole Workbench team. I mean, that is not AI written. That is like actual hours and hours of curated work. But we have LPs on in. I think truly, even if they read one or four of them a year, they get a sense, okay, well, Workbench is doing what they said they're doing, which is they're doing enterprise in seed.
And they see the drumbeat of consistency.
And they see the consistency. We do these write-ups of, this is what we did in the last quarter, right? And then these quarterly LP webinars help a lot as well, because you get a little bit deeper inside look on like how our companies are doing, what are some investments like. So I think it's that building in public, because again, if you just wait right at the time you want to raise, it's just not enough time. It takes so long for them to get the data points they need to build conviction.
And the coolest part is, by the nature of our model, right? We're speaking to corporates, and then we blog about our research. We talk about the playbooks for scaling that 0 to 1 go-to-market journey. Go on our blog and read it. So all that is attractive to founders, but also when people want to say, oh, are they actually doing what they say they will? Go to workbench.com/blog. Go to our playbooks page. Like, read it and see what we're doing in action. See the discipline. See the consistency. You're not going to find a lull there. And you know that we've been doing it for over a decade.
Yeah, you got to let them lurk, right? So, okay, cool. The next one I actually thought was really, I think back to like these key moments that like have stuck in my mind. And I think one of them is just, again, how many GPs have helped us through the years. And in the early days when, again, we have very limited track record, how do you get an LP to want to take a meeting with you? It was a few very critical GPs who we had co-invested with, who we had been on the boards with, who saw how hard we worked and who opened doors and who really put in a good word for us and said, hey, you should talk to these guys. They're the real deal. They work really hard. And I just think without that vote of confidence, it would be so hard. So I think the reason I say that is because these days, like we meet with so many GPs and we're always happy to put in good word. Like, trust me, like John and I know how hard it is. We are the first ones to always say, we're happy to do an intro. But our intro is going to be even more powerful if you and I have worked together.
Exactly.
Right? And so like, that's really like the name of the game is like, find great investors to work with, work and collaborate together and give them a chance to like speak really highly of you. And so again, I think we want to do more with great other GPs, right? Yeah. So this is a call for that as well. But it just allows us to speak a lot more authentically, to say, hey, look, I've seen them in action in good times and in bad. Like, this is one to really back.
Yeah. And I mean, very tactically, right? We started off in that $10 million fund one. We weren't leading rounds yet. So we were earning the right to get on cap tables with some incredible different funds. So take Sunil at Amplify, right? We were on the Backtrade board together for many years, and we were kind of his feet on the ground in New York, working very closely with Abel, Sammy, and the team, and really built a relationship off that. And you and I, when we talk about what we want to be, I mean, what him and Mike and everyone on the team has built there at Amplify, we're just so impressed by it. And they were very giving with time and insights and actual LP introductions. I think back to deals we shared with Ping and Voss at Excel. And, we had done multiple deals and they saw, hey, we talk about go-to-market and we're actually lighting up Semmel with customer intros that are converting. Yeah. When you then go say, hey, can you help me out with an intro? It's not just, oh, let me think about it. It's, sure, take some intros and I'm going to put in that good word, really affirming you're doing what you say you will.
It goes such a long way. And because a lot of LPs at the end of the day, they meet so many funds. And so actually having, again, that vote of confidence, I think is immeasurable.
Yep. And then it led us over time build that LP base and then build the fund size, because our dream was always to lead. Right? Like we have this conviction before anyone else. We want to help them for that 0 to 1 where we're uniquely positioned with the fund. We're concentrated. And me, you, Kelly, the whole team, we want to really roll up our sleeves and help, and we can, and then set them up for that massive Series A. And you can't raise that bigger fund to write those bigger checks to lead until you've kind of done the groundwork, oftentimes as that co-investor. Yeah. And I like your call out to the pre-seed funds. Like, let's do more together.
Let's do more. Come, let's do great deals together. Okay, this was number 2, but this might be whatever number we are on, number 6, which is all about, this is, I think, the best tactical tip is, when you've got some folks in the door, you're trying to get to a close. It's hard, right? You want to create urgency, but as any of us who have raised a fund knows, like creating urgency is not always possible. You could set a deadline, but that deadline, as we all know, is artificial at best. And so the tactic I know many people have also shared with us is using slots, right, for different segments of LP groups. So maybe talk about that.
Yeah. So really the context here is you've got actually a critical mass of conversations, because you need first to start and find out who are my true believers that I feel like I could potentially get a first close with, but maybe they're not ready to act yet. Yeah. And you haven't done the close, so you can't get that second group. How do you actually build momentum in the rest of the pipeline? And this concept of slots is saying, hey, if I'm raising a fund that's this size, I'm going to have a certain amount of family offices, a certain amount of fund of funds, a certain amount of individuals. These are the minimum checks in each category. And again, ultimately, you cannot FOMO them to say, this is my date, I'm closing, you're in, you're out. But when you start creating these ways of saying, all right, there's only 2 slots left in this category, it reframes it from there's this much away from the final close and things like that. So it really just helps change the conversation and better align you.
Yeah, absolutely. Then number 5, 6, where we are, being careful with MFN.
Oh, gosh. So this is what I've heard a lot. As we're saying, we get now for that next generation, as we're on Fund 4, talking to pre-seed folks that are on Fund 1. And what a brutal environment, right, to raise it, unfortunately. So people that are really hustling hard may find a group that says, hey, I'll participate, but I want a piece of your management company. I want a piece of your GP and carry for the next 2 funds. I want fee waivers. Like, people are working so hard and you're working your pipe and no one's willing to commit yet. And then you find this group that's willing. Yeah. So often it's a landmine. Because what happens is MFN, for people who don't know, means most favored nation. If they get a specific clause, every other LP that's really institutional grade and sophisticated is going to say, let me see your side letters, what MFNs are there and what clauses, or let me have an MFN, what clauses should I be aware of? And you could end up killing your management fee stream, killing your upside a decade from now. And we battled this too. There were many LPs. And I'll never forget, a couple of our early believers said, do not do it. And we're like, come on, we need to do this. Like, it's just one thing. And we stood our ground when we raised that $49 million Fund 2 from scratch. And it was so hard. But think about it today. We are so grateful that, we have a very clean, we own the management company. We are as vanilla as it comes. Yes. No special fee waivers. And we're just able to focus, stay motivated for the long haul, and then, just run our business. And you got to just keep going. If it's going to take some of these fee waivers to close your fund, maybe you got to rethink some of the messaging, the strategy, the people that you're talking to.
Yeah. I mean, it feels like such an easy give, but it's a very slippery slope. Yes. All right. Number 7, what to have in your data room. I mean, I thought this was one of like the most useful things in the beginning. And it's funny now because obviously we have lots of thoughts for founders when they have data rooms, and like a lot of that has translated here. But it's the same thing. And just as we would want our founders that we meet to have very thorough data rooms that really go into detail about parts of their business, I mean, we should expect the same as well, right? For investors like ourselves. So do you want to talk through some of the decks that we've put in?
Obviously, oh, man.
In addition to the overview deck.
So, of course, there's the overview deck, which has had 93 different versions, right?
V1,
in the early days.
V7, V7, D6.
And especially what I'm really grateful of just on that point of the overview deck is, think about the Fund 2 days where almost every meeting it changed and we had to adapt and we didn't know what the full story should be.
Yeah.
Oh, man. Fund 3 got a lot crisper in Fund 4, and I don't think it ever changed. So that was cool.
That was very cool.
Yeah, to see
the story is the story, right? And we're changing some numbers, which is good. It's a good thing on changing numbers and some new companies. But, yeah, I mean, that was really cool to be like, wow, this is the model. Yeah.
But so you called out Mike, and I remember, I'll never forget, the 2 things he showed us that LPs wanted to know, and it showed such a maturity to have it, was the investment process and the diligence deck. And process is kind of self-explanatory. How do you do it? What do you do? Every firm's a little bit different. How do you build conviction? Give examples. But then the diligence side, part of our model is compared to other generalist seed funds that look at team, product, market, we actually have voice of the customer feedback as part of diligence. So that is a big angle that we like to flex. It ties to the themes and then value add. It helps you win deals. And to be able to showcase that in an actual diligence deck and give real examples, then have founder testimonials tied to it, and then put the case studies, obviously a couple in the overview, but then some here, that was a needle mover on our efforts. Yeah. And I'm really grateful that we had been given that advice, and that's something that everyone should think about.
Yeah, and again, these are all things that come up in the process, right? So they're going to ask you these questions, and so just by front-loading it and just saying, hey, look, we know you're going to ask these questions, and we've thought about it, and we put structure around it. It's just those small things, but they add up, right? All right, number 7, 8. You had shared about knowing. Yeah, I think this is about knowing who you are, but also knowing what box you check for the LPs, right? So again, LPs have a whole portfolio, and you're one of them. And the reality is they have their own construction as well of how they think about how they'd like to deploy capital and build their portfolio. And so, for us, I do think, as much as the early days was like so hard and we were so contrarian and we were the only ones in New York, I frankly think it's helped us a lot in the more recent funds when LPs have realized, hey, we're actually overexposed in SF. We have so much exposure in SF. We do not have enough in New York City, and we obviously had to wait and build a long time for that momentum to come. Same with enterprise, right? For a long time, people had a lot of exposure in consumer. We were able to help them check the box on enterprise software. Do you want to talk a little bit about understanding where you fit?
Yeah, and I think the key is it's not about changing who you are, right? Anyone that knows this, we're New York hustle, enterprise seed fund, we're go-to-market oriented, right? That's the same. Yeah. But to your point, for an LP that might have a bunch of enterprise funds in SF, play up the seed angle and the New York angle, right? That's a unique exposure to geography they don't have. And that's where inviting them to one of our enterprise tech meetups or a different event that we host, they see it and they feel it. That's where our old funding reports came to bear, saying, hey, we're growing and we're becoming a real thing. And again, now it is a thing, so you don't have to track it so closely. But it's really around seed. Most seeds are generalists. So leaning into, here's how we do it differently. We're not a spray and pray index fund. We're taking a concentrated approach. We're doing a lot of legwork, but we're getting the ownership. Here's the data. Here's the customer wins that we bring to bear. Here's how they benefit. So it's really figuring out how do you close them based on that and really, or move them along and then close them based on what box you take and leaning into that part of the story. Yeah.
Again, differentiation. I mean, that is absolutely the name of the game. And, the reality is too, just it depends on how you are building your firm in relation to others. If there's a lot of other funds that look like you, or if they've already invested in a lot of funds that are similar to you, it's just going to be harder, right? Yeah. Because everyone needs diversification, especially LPs, right? Yeah. And so, in a lot of ways, it's, I think our model has been hard in some way, or at least like, the origin story was not like so easy and obvious, but it has helped us when other folks have needed just wanting to get more exposure to what we're building.
Yeah.
And what we're building. All right. Fund admin. Do this whole episode. We could do a whole episode on this.
So a lot of people come in thinking, I want to raise my own fund. I'm going to write checks. I'm going to work with founders. It's all roses. And they don't realize that when you're not part of it, especially people that leave bigger platforms that had a massive marketing team, a massive IR team, a massive finance team, like, guess what? It falls on you.
You're doing all those things and more. And changing light bulbs and fixing the printer.
All of it. So getting the right support system, right? So they don't give us a lot of credit on is we're very scrappy. But in certain areas, legal, we have the best team, both for deals and fund formation from Cooley, right? Shout out to Kaylin and Aaron on the fund formation side, Roy, Nora, Sasha on the investment side. Like, when we're best in class and specific to the raising part with Kaylin and Aaron, when they would get on with an LP, when we were at LPA point, think about it. That it brought so much legitimacy to us because they're like, oh, you have Cooley docs? That's going to be top tier vanilla and it's good, right? Fund admin, you need that partner. So like, we're obviously not the fund administrators. But as the founders of the firm, we're engaging with them to make sure we have the right numbers being presented in quarterly financial statements, that the SOI is up to date. Me and you are running a firm, a 6-person company, managing the budget of the management company. All that ultimately falls on us, on top of everything we said around your AGM and making sure that you're communicating with LPs. So you have to really lean into it and make it top tier, but also figure out leverage points and how to make it a strength. And I think we've invested in that. We spend the time. And, when we talk to LPs, something I'm proud of is we communicate well, we deliver information they need, and it's a very smooth process. Yeah,
and something that, again, I will give you all the credit in the world very publicly is how much you have really led and managed the finance side of the house, which is like not easy. And that is the thing. That is probably the number one thing when I think about starting in 2014 to where we are now, like knowing how much work goes into that side of the house. Fund admin is one part of it, but having a CFO, we're so lucky now to have an incredible part-time CFO, but for so long you were the one doing it all. And especially in certain seasons, whether tax and audit can really take you down, right? And if you have SPVs, you roll those in. I mean, it is truly a full-time job, and having someone very qualified, very thoughtful who's running it, I feel so lucky we have that now. But that is the part that I think is just so hard as an emerging manager, right? And the dream is to be able to get to a place where you get to work with the best of the best, whether it's legal, finance, so forth. So they do that, and we can focus on what we do best, which is finding the best founders and working with them. But I mean, huge credit to you for managing for over a decade, truly. Thank you. And also shout out to Sophia, who's been an incredible leverage point, right? Once it reached a point where it was just too much work for us, having her with the fund admin combo it just gave us superpowers, and it also gives us visibility into the business and thinking about reserve strategy and things. Again, like when you think of the startup world within finance, there's like more pencil pusher accounting, and then there's like the strategic FP&A part. We're now doing more of that strategic forward-looking finance part to just be better at what we do and buy up in the right companies and have a better sense of cash flow planning and things like that. Again, not the sexiest stuff, but when you think about our jobs and fiduciary duties and portfolio construction, it all comes to bear. Yeah. So that support system is critical that we built over time. And she's taught us so much, so huge thanks to Sophia. But it really goes back to the point earlier, just being a fund manager, right? You can invest in great companies, but what do you do? How do you manage that investment along? How do you double down? How do you take out? How do you exit, right? Like those are all the things that you only see once you're many years in, to be honest. You need those reps to see it. Yeah. You need those reps. Awesome. You have something here on number, I guess, 10, is about, of course, once you've raised a few funds, you're not going to, of course, have the same exact LPs in every fund, which is actually very normal. So do you want to talk about that a little bit? Yeah, and it touches on a few elements. Number one is Rory from Scale. We're luckily in Secure with them.
And he's given such good advice over the years. And he said, you're always, no matter how well you do, unrelated to you, you're going to gain some new and you're going to lose some LPs each fund cycle. And I think it's an important mindset that you've actually never, so to speak, made it where you're just going to have that base and you rinse and repeat. So I think about for us, right, we both were going 10, 49, 125, and with this fund 160, we've evolved. You've also had market forces at play, right? In the early days, the only people we really could close were some of those fund-to-funds and high net worth. Fund 3, we really grew up and brought on first endowment and pensions. And even when we're raising Fund 4, it's interesting. We're coming off the end of ZERP, and a lot of people had really overextended themselves 21, 22. So we're out there raising, and especially if you're a small family office or high net worth, you might have gotten liquidity. Yeah. So as much as we love them, they love us, they're like, hey, I don't have money right now. What should we do? And it was an interesting moment where we would never boot a smaller LP because they were our earliest supporters. And we have some people who have been with us the whole journey, and we're so grateful.
Totally.
But at the same time, it also opened up space where we said, hey, there's this new endowment we want to bring in. That clump is out. This new clump is in. And, just being constantly in conversations with people to understand where they're at and making sure that you're managing that appropriately as you scale.
Yeah, and again, it's when we talk about enterprise sales, it's truly like how do you reduce churn?
Yeah.
How certain customers are not a good fit for you at a certain point when you mature. How do you expand certain deals and accounts, right? So the framework is exactly the same. And again, huge shout out to all of our LPs who have truly enabled us to do this work, but especially the ones in the early days who took a huge bet on us, right? And I mean, we had no proof points. I will say we definitely had a model that I think was unique and interesting and is still unique and interesting, but really with the community and the corporate engagement as the two flywheels. And the work on us now, I think, is like, how do we continue to improve upon that and keep building on that? Sweet. I think we're at number 12 now. We might have skipped one or two.
Jumped around a little bit.
This last one sounds easy, but it's obviously harder to do in practice, which is do what you'll say you'll do. We talked a lot about this in the beginning. Just like discipline, right? And especially in times of crazy hype cycles.
Look right now, right?
Part. This is 2021 right all over again.
I can't tell you how many, we'll catch up with LPs and they'll talk about the market with us and they'll be like, I have funds saying they wanted 10%. And they're settling for 10% ownership, and they're settling for 4, 5, 6% ownership because they had to get into this deal. They had to get into that hypey deal. And yes, there are some outcomes that are bigger than ever and quicker than ever, but those are more the exceptions. And if you just totally go off model from what you said you would, what are LPs underwriting? You're not giving them what you said you would. And when it comes time to raise that next fund and they're evaluating you compared to your peer group, unless you've somehow blown it out of the water with that different strategy, most of the time they're going to say, you didn't do what you said.
Yeah. Which again is that's the hard part, obviously for the two of us, but also for our team, right? Because it might mean that we sit out on some deals that we are so in love with, right? But that again is the benefit of 10 years is that almost always those deals that we either lost or passed on or didn't win or whatever, it's for the best. Right? I think it's very few that were like, oh my God, we should have done that. We should have gone off model for that one company, but you just don't know. I mean, you have to fast forward truly 10 years to see how it shakes out.
Yeah. There's always those couple where it's like, oh, I wish, but more so it's what you said. And let's be real, it is hard. You do all the thesis work, you spend time with the founder, you love it, everything is aligned. And then you come time to term sheet and you are totally misaligned. And you spent so much time and effort and pumped up the rest of the team. Yeah. And it's being able to say, you know what? It's not meant to be on this one. And we got to get back to the next one.
Yeah. It's a great company, but just not for us. Right. And we just have to know what are workbench companies, what are not, and have that conviction, right? And have that confidence in ourselves.
Yeah.
Okay, one T that we didn't talk about, but it's literally tea. And we think about this story all the time. And I want to share this because I just think it's so important. I feel like maybe people are more transparent now, but I just feel in the early days, fundraising was so hard, right? And I do think some GPs said, yeah, it's hard for us too, but like I kind of wish other GPs were more open and were like, this is fucking hard.
Yeah.
Right? And so that's why I'm always the first to tell people, like, look, for us it has not been an easy road. It's still not. I would never take it for granted, right? Like we still have so much to prove out and we're working on that. But I think this tea story is hilarious because I think it like totally encapsulates just like honestly the shit we also had to go through, right? Close the previous 3 funds.
So this is when we're raising the $49 million Fund 2, our first institutional fund.
Was it for Fund 2, not Fund 3?
Yes, Fund 2. So it's early days. Still figuring out who to talk to, and we went to this LP conference. I think it was the first ever raise event, and we applied to present. We didn't get to present that year. In a future date, you crushed it.
Yes.
And basically this event is one of the few that actually brought together GPs and LPs. And what's really... looking back, what's crazy is there was 2 distinct sessions. One was the GP room hearing from farther along managers and maybe one LP that goes and talks. But the other room was really the LP event and like hearing a couple pitches. And the only way to get access to that other room was in the middle, which is this big open, banquet hall where there was just tea. And what I did that day, as we're desperate for pipeline, I'll never forget, I flew to SF. There was an attendee list. I looked up in the days before and on the plane, every attendee, every LP I could possible, learn their names, face, had done some recon around like who could be a fit for us, who's not too big, because at that point we're learning a bit. And I had my hit list. And again, only one person, 2 people are coming out of time to go to the bathroom. And what I did is I stood by that tea table, and anytime an LP went to get a coffee or tea, I got a tea. And I would stand next to them.
Speaking of lurking.
The lurk was real, and it was shameless, and I felt like garbage doing it. It was so humiliating, but I stood by there,
you would, like,
made
sidle up to them.
nice mint tea, sidled up, and I'm, hey, how are you? I'm John. What's your name? Obviously, I knew who they were at that point. And then I did the little elevator pitch, but it was the tea pitch. And in the time that they were putting their sugar or their milk in their tea or coffee, I had a pitch, and a lot of people we weren't a fit for, but I got a few follow-ups that day. And the funny part is I did that for hours. So literally I would make a tea, and I can't even drink hot stuff. I'm iced coffee every day. So I would have some of it and then put it down somewhere. And then I'm waiting like 6 minutes. I'll have that tea finished. Someone else comes and I run and do it again. And like every 3 teas now, I'm like, oh shoot, I have to go to the bathroom. So I'm running to the bathroom, and then I'm waiting for more people. But that is the famous tea story because we just grinded it out. Yeah. We were shameless. And if you're not willing to do that and put yourself out there, then you shouldn't be raising a fund.
I totally agree. I mean, there are literally no shortcuts. And the word shameless is spot on, right? Because you're going to have to truly beg, borrow, steal some LP intros and relationships, right? And like I said, you're the best SDR Workbench could have ever asked for, and you do have to be willing to put aside, a lot of your ego, whatever it is, to ask for favors and ask for intros. But that's what it takes to get done. Oh, here's one more tactical tip that I'm seeing other funds do now. We didn't even do it, but getting references is a huge part of the process, right? Obviously, LPs like you, they meet you, but they're like, we want to talk to other people to back up what all you've said. So they'll want to talk to founders and maybe other investors. And we would do this thing where we would obviously tee up the intros and then give context perhaps to our founders, say, hey, listen, if you could highlight XYZ things. I mean, I've seen people to put together like really good packets now that are like everything you need to know about Workbench, like the hit list of things that they might want to talk to you about, things that would be helpful for you to highlight, and I think that is really smart, right? Because as much as you think everyone knows the ins and outs of your fund and what makes you great, giving a little reminders is really helpful too. It's so smart. Anything else that you think from a tactical perspective?
The last thing, and I'll give credit to Rick Zullo here in New York for it, is find your community. I think back to how many of the nights we just had whiskeys lamenting. Again, back then, you didn't know who the LPs are, who's legit. He really built this emerging manager community. And back then, we must have had a pod of like 4 people. Yeah. And the key is none of us conflicted with each other's strategies. Yeah. And what we would do is when we got intros, when they were, at a point where either it's not a fit for us anymore or it's far enough along we can connect with someone else, we would swap intros. Yeah. Again, these are LPs. They may want consumer and not enterprise. They may want New York. They may want fintech versus this. And having that peer set where, you know, again, it's a grind. You can lament to each other and just be that emotional support system. You can swap notes.
Yeah.
And then even the back channel. Hey, this group says that they're active and they waste your time. This one stood up another one at the altar, didn't sign the docs. And like getting that real talk, which is not available out there publicly.
Totally.
When you find your people and you do that together, it's a great support system.
Totally. Even just to know like, okay, we're not the only ones going through this.
Yeah.
Right. And just even be able to give the real talk of, hey, this really sucks.
Yeah.
This is really hard. I mean, we have a whole another episode we should do, which is when we kicked off our Fund 3 fundraise, March of 2020. And that raised, you know, quite transparently took us a lot longer because obviously there's a global pandemic. I think there were some pros to that, which, you know, I've talked about, which is because everything was forced to be on Zoom. In some ways, you were able to be a lot more efficient with meetings. You know, the downside is obviously you couldn't meet in person, right? Which obviously you lose a lot of that in person. But we were able to then stack meetings, quite frankly, back to back to back.
All day and all night.
All day.
And we emailed them updates and we followed up. I will never forget that time. I mean, the hard part in that, Mark, just as a heads up for anyone raising now, there's always going to be something. For us, it was COVID, everyone paused. And then as things actually went wild and opened up with Zerb, what ended up happening was you would have a group you've known for years and they say, hey, I write $5 million checks. I've got 3 slots this year. But they might have been in Sequoia and Andreessen and they go, oh, actually, my $5 million allocation got bumped to 10 because their fund size grew. And they have a new product. They have a crypto offering. They have a dedicated growth fund offering. So actually, my 5 is 20. So that delta of 15 million, that's 3 emerging manager checks that got wiped out. So that year, it actually was very hard.
People coming back to market way faster, right?
Came back faster, came back bigger with more products. And people today, there's all these stats of, oh, the big firms have gobbled up all the emerging manager pieces. It was like that in 2021 too. Yeah. The trick is you just got to find out who has the capital and can you differentiate. So it's, you know, that lasting message I think to leave on is it's never easy. Figure it out. And that's part of this, step 1 of this journey if you want to build, you know, not just the ability to invest, not just a fund, but a franchise and a...
Yeah. Last thing I'll say is you got to find the fun in fund, you know, and I'm the first to say, like, I'm so lucky to have you as a partner because you're actually so good at fundraising because you so genuinely love what we do. I would say, like, for me, it's been a learned and earned skill, right? But you just have to be able to find the fun and find the laughs and find the tea, you know, because otherwise it is just, we didn't even talk about managing the fund on top of fundraising, right? So closing new deals, meeting founders, and then at night going back and working on, you know, the pitch deck and all of that. So hats off to anyone who's ever raised, hats off to anyone who is raising. We salute you, and we're really excited to be able to share some of our learnings here on the drafting table.
Sinusoidal journey, but wouldn't trade it for the world.
Yeah. Thanks so much, John.
Awesome. Good to be here.
Wait, you have to say tweet away, tweet often.
Tweet away, tweet often, tweet till your knuckles bleed.